Farms.com Market School with expert commodity analyst Moe Agostino is an online educational video series designed to help you, the farmer, improve your knowledge of grain marketing. Farms.com Market School is brought to you by DeKalb Brand Seeds. DeKalb, growing confidence. Today's video is about working with a commodity broker. Today's topics include the role of the commodity broker, how to place orders such as market, limit, sell, stop orders. Those are really the top three orders you really need to know when dealing with a commodity broker. And then what to say when placing those orders with a commodity broker. Third topic, examples when shorting futures or buying put options to hedge. So again, what to say to that commodity broker when we're giving you these examples. And then what rules to follow once the hedge plan is in place. So let's start off with our first topic today. What is the role of that commodity broker? Farmers need to call a licensed commodity broker. Unfortunately, you don't have a license to trade in futures and options. And so you're going to have to open up a commodity hedging account. The role of the commodity broker should be limited to understanding and perhaps assisting in the development of the hedging or marketing plan, providing further information on any technical features used to trigger futures or options, contracts, or positions, filling orders promptly and executing at a low cost per round trip. Again, you only want to be charged that $20 to $40. You're not going to rely on them for full service advice, because if you do, they're going to start charging you as much as $70, $80, $100 per round trip. And then finally, providing accurate and timely position records and monthly statements. Our second topic today is how to place orders and what to say to that commodity broker. So there are three types of orders when working with a commodity broker. Number one is a market order. Number two, the limit order. It's the preferred method. And then the final is the stop or sell order. So let's start off with our first order called market order. Market orders are the simplest and most common type of futures order. You will want to use a market order when you want to get filled quickly, where the market is currently trading at more or less. Market orders have priority over all other orders, which means they will be filled before limit orders or stop orders. A market order does not specify a price. If you're trying to buy a futures contract, you will normally get filled at the ask price. There's a bid and an ask. If you are trying to sell a futures contract with a market order, you will normally get filled at the bid price. So in front of you is a chart that just shows you an image of quotes, and in the far left column is the contract, and then the red column where it says net change is the net change for that futures contract for that particular day. So for example, March 2012 corn is trading at $5.97 bid, $6 ask. If you place a market order to buy, you will probably get filled at $6. If you place a market order to sell, you will probably get filled at $5.97. You will sometimes get bad filled prices when trading commodities, so don't always expect this scenario to happen. One needs liquidity, as in the electronic markets like the S&P 500 or the Dow Jones Industrial Average. Liquidity simply means trade where, for example, the CME, CBOT, where there's a lot of participants. Remember that markets can move quickly, so the bid and ask prices can rapidly change. Let's talk about our second type of order called limit orders. Limit orders are orders to buy or sell a contract at a specific or better price. Limit orders, again, this is the preferred method. So if you're going to put an order in with a commodity broker, please use a specific price. Limit orders may or may not get filled depending upon how the market is moving, but if they do get filled, it will always be at the chosen price. The chosen price is the price you said to the broker, or at a better price if there is one available. For example, if a farmer placed a limit order with a price of $14 a bushel, the order would only get filled at $14 or better if it got filled at all. Limit orders are used when you want to make sure that you get a suitable price and are willing to risk not being filled at all. However, a farmer can use a limit order and add 2 cents discretion. In other words, you can say to the farmer, look, I want 14 bucks, but you give you 2 cent discretion above or below. And you either get filled at 14.02 or 13.98, and that may end up getting you that order filled. Let's talk about our third type of order called the stop order. Stop orders are similar to market orders in that they are orders to buy or sell a contract at the best available price, but they are only processed if the market reaches a specific price. Stop orders are processed as market orders, so if the stop or trigger price is reached, the order will always get filled, but not necessarily at the price that the trader intended. Stop orders will trigger if the market trades at or past the stop price. So for a buy order, the stop price must be above the current price, and for a sell order, the stop price must be below the current price available. For example, if the market price is $6.50, let's assume we're talking, it could be wheat or corn, farmer might place a buy stop order where the price is $6.55. If the market then trades at $6.55 or above, the farmer's stop order will be processed as a market order and then get filled at the current best price. Stop orders are mostly used to protect a profit or limit a loss. Our third topic today is using examples when shorting futures or buying put options to hedge. So in these examples, we're going to show you what to say to that commodity broker. For example, a farmer wants to hedge 5,000 bushels of corn in June. He or she expects to harvest in the month of December. The farmer would call his or her commodity broker, pick up the phone, place the following limit order and say, please sell one 2011, let's assume it's 2011, December corn futures contract at $6 a bushel with a 2-cent discretion, allowing the broker to sell that one 2011 December corn futures contract at $6, $6.02 or $5.98 per bushel. You can also place the order in as a day order or good till canceled order or specify a date. However, if you put it in as a day order, remember it only lasts for 24 hours. So you're going to have to call them back again the next day. They're not going to place that order back in there until they get instructions from you. So you would be better off to probably give him a week, 2 weeks, 3 weeks. We prefer putting it in as a good till canceled order, so that way when it's filled, it's filled. If it doesn't get filled, then it's still, you're going to have to call them back and change the price if the market's moved on you both up or down. This same farmer could have soybean bushels to hedge and call the broker to place the following limit order and say, please sell one November soybean futures contract at $14 a bushel with a discretion of 5 cents, allowing the broker to sell at $14, $14.05 or $13.95 per bushel. Why 5 cents? Well, beans are twice the price of corn, so I increased that amount of discretion on the beans versus the corn. Our fourth topic today is the rules to follow once the hedge plan is in place. When placing an order with a commodity broker, follow up to see if you received a fill. Brokers are busy and they may not get back to you. Our second rule is once an order is filled, ignore the noise until the physical commodity is ready to be delivered. You start to use emotion, maybe the trade goes against you, ignore it. For example, a farmer shorted one corn futures at $7 a bushel. $7 a bushel for corn is pretty good, but will not harvest until October. When October rolls around, corn prices have dropped to $5.75 a bushel. Now along the way, as that price is dropping, are you going to take a profit? No, because you still have the bushels in the field, or maybe you're just about to harvest. So our farmer would only buy back this position when the bushels are finally delivered to your local elevator. That is a true hedge. Anything other than that, you're speculating. So in summary, having a commodity broker that understands your hedging and marketing needs and plan can have a huge impact to your bottom line. The ever-increasing volatile changing commodity market environment in the future will require that each marketing plan include a commodity account as part of that plan to manage and navigate through the highs and lows. Remember, commodity accounts are used only for hedging purposes, not to speculate.